What's up, guys? It's Sam Kasima. Hope you're having a great day. Today's video, I want to talk about the recent Federal Reserve comments from Jerome Powell at the Jackson Hole Summit. Now, this is a monetary event summit where they talk about current economic conditions and what they're going to do going forward. But before we get into the video, I just want to tell you guys, if you like this type of content, please go ahead and like, subscribe, and share. I really appreciate it. Help grow the channel. Now, let's get right into it. So yesterday, Chairman of the Fed, Jerome Powell, actually had a press conference where he talked about monetary policy and kind of signaled what the Fed will be doing going forward. So currently, in the past couple of years, we've been in a high interest rate market, high interest rate atmosphere where the Fed has actually really tried to keep interest rates high to keep inflation down. After the pandemic, interest rates got as high as about 9%. So what the Fed has been doing over the past couple of years is keeping interest rates high to keep inflation down. So they've done that. We're down to about 2.8%. But in the last couple months, we've seen a real slowing of the jobs, right? 38,000 jobs average over the past 3 months when it's supposed to be closer around 100,000. So now the Fed is signaling that they actually may again cut rates. They did one cut last year in November, and they're looking at possibly doing another cut in September next month. Now, why is this important to you? So monetary policy is really following what the Fed is actually doing. So when the Fed has interest rates high, it means it's expensive to borrow money. Companies aren't going to be looking to expand. They're not going to be looking to hire. And it really has a down effect on the economy. But they're doing that to keep inflation down. And when it comes to real estate, you've actually really seen it kind of work in certain areas. You've seen the real estate market actually really cool off over the last year or two, even in my area here in New Jersey, where we've had crazy bidding wars over the last few years. It's really calmed down. I'm not going to say prices have come down, but they've definitely stayed flat over the past, let's say, 6 months. And that may actually continue. But now with this new signal from the Fed saying that there actually might be cutting rates, that could change very, very quickly. So his comments that he made yesterday was basically saying that in light of the poor jobs numbers, in light of inflation being roughly around their target of about 2%, it may be time to change economic policy and start to cut rates. Also, that means that basically they're turning on the money printer. So over the past couple of years, in addition to high rates, the Fed has been doing something called quantitative tightening. That just means that they're taking money out of the economy. Now, in the past, they do this again to keep inflation down. But the cost of keeping inflation down is poor job growth, a slowing of the economy. So now they're at a point where they're trying to weigh the balance of, do they want to keep unemployment low, or do they want to keep interest rates and inflation low? So right now, they're about to probably make a switch where they're going to cut rates, which will then also allow a little bit more inflation, but also stimulate the job economy. So when we see this happen over the next few weeks, the few months, it's really going to have an effect all over the economy. And what you can expect and what we saw yesterday was the stock market loves low interest rates. So just the thought of the rates actually being cut has actually made the market go up 1.5% in the S&P yesterday. And we will continue to see the stock market rally in a low interest rate environment. So this is why you want to pay attention to these types of different things in the economy, because it has an effect on your investments and it should have an effect on your strategy going forward. So for me, as a real estate person, when interest rates come down, it actually may also lower mortgage interest rates. Mortgage interest rates have been high over the past year and a half. And again, it's lowered the demand for mortgages, lowered the demand for properties, and it actually kept property values somewhat stable. And it's actually dropped in a lot of places where they went really high, like in Florida, Texas, even Nevada, Las Vegas, where you saw lots of price appreciation over the past few years. Now, with a return of to low interest rates, if they continue to cut rates and they go from quantitative tightening to quantitative easing, which is basically money printing, assets are going to go up, right? When the money is cheap, when they turn on the money printer, stocks are going to do well, equities are going to do well, digital assets, Bitcoin is going to do well. So we're really trying to wait and see how many cuts are we going to get. We're actually at about 4.5% on the federal funds rate. In September, we may cut that another 0.25% to bring it to around 4.25%. And we may even possibly get another cut in November and maybe possibly again in December, where we could see maybe a half to all the way to 1% cut in the rate. Now, while traditionally the Fed's funds rate doesn't dictate mortgage rates, they kind of could have an effect, because what determines mortgage rates is actually the bond rate, right? The 30-year bond rate. And as long as the bond yields are coming down, then it'll actually make the mortgage rates come down. So that's something to keep an eye on, because now if mortgage rates come down, that means that's going to bring back demand for mortgages and demand for people looking for housing, and that could actually make the price of real estate go up again, where it's kind of been flat over the past couple of years. So these are the different things that we need to factor in. And if you know that the Fed is actually going towards an easy monetary policy, you definitely want to own assets, stocks, even businesses, right? If you can buy a business, have a business, it's going to be easier for you to borrow money. It's going to be easier for you to expand. Obviously, digital assets, you see what's happening with Bitcoin over the past, couple of years, and it'll probably just continue over the next few months as rates keep on getting cut. So just wanted to share this information with you guys. I'm going to keep on trying to give you updates on what I'm seeing in the market, different things that I'm doing as well. And again, if you stayed this long, appreciate you. Please like, subscribe. We'll catch you on the next one, and hope you have a great day.